silver can easily outperform gold. Look at the ratio. If I'm bullish on gold, typically I'm bullish on silver. So I said they tend to move in tandem. In silver, there is less open interest, meaning there's less a buy to a sell equals one contract, that's open interest. And there's less open interest, less volume. Physical gold, typically you're in it for the long run. You don't usually flip within months, or once stops start getting hit, there's a liquidation and the fear of remaining long. In terms of, it's hard to pick a bottom as it's coming down in a fast and furious way. He was stuck. We're going to tackle 2% inflation. His bark was louder than his bite, so to speak. In other words, he carried a big stick, but he didn't really use it. That's why you saw gold recently, I believe, moved higher and silver moved higher, because it's against the basic principle that when you have war, geopolitical tension, that tends to be extremely bullish for gold because it ratchets up the uncertainty factor.
Okay, well, listen, silver's been, the real story here. It's up more than twice what gold is today. When you were last on, it had lost 200, lost its 200 that day, I think. So, I mean, has it taken that back? And is this, the outperformance that you said we'd get on the way up, or is it just kind of still one session is noise?
Well, the similarities in gold and silver in terms of price range, percentage gains and losses, is if you look at January 29th, that's when gold topped. You had a series of lower lows. But the fact that silver broke 100 effectively resulted in the largest percentage gain where silver outperformed gold. And during a rally, typically gold outperforms silver in terms of percentage gains. During a drawdown, silver can easily outperform gold. One is the liquidity and volume, the open interest, number of contracts. And silver is not traded with as many contracts as gold is, so you have a different liquidity. But in terms of the year, I was really, when we consider that at the beginning of the year, we saw silver move not only past 100, but 123, because its base and ceiling was at around, about 60 to 65 in terms of the records we witnessed prior to that. As you can see, there was this slow, methodical move up as we were trading through 2025, take a small dip, and you get almost a parabolic move to the top.
Yeah.
And the top was roughly double of what we saw as a baseline for silver. Gold somewhat the same, but you get wider moves.
If silver keeps outperforming gold while liquidity stays thin, the next move could punish investors who mistake volatility for weakness. As Gary Wagner notes, silver's smaller open interest can magnify the same catalyst into larger percentage moves. The ratio falling from roughly 69 to 67 in 11 days suggests meaningful relative strength. For investors, that volatility cuts both ways. Upside accelerates, but reversals become violent. Next, Gary Wagner exposes why physical accumulation tells a different story.
Yeah. I mean, again, silver put its low, I guess, for the year back in July. It ended the month near 57, 50. It's printed 66, 68. So, I mean, a lot of people talk about the gold-silver ratio. And for anyone kind of new, that's just how many ounces of silver it takes to buy an ounce of gold. It's come in from about 69.5 to around 67 in 11 days. So do you trade the ratio as its own chart at all, Gary? Or is this still just noise and it's starting to signal something?
I look at the ratio, but if I'm bullish on gold, typically I'm bullish on silver. So I said they tend to move in tandem.
Yeah.
The difference is the percent gains or percent drawdowns, which can be significantly larger on silver. And I think part of it has to do with the fact that in silver, there is less open interest, meaning there's less a buy to a sell equals one contract, that's open interest. And there's less open interest, less volume, let's say, and therefore it will react more sensitive to the same fundamental events.
Big week, I guess a big month coming into September as well. Hey, something I should have asked you last time, Gary. I mean, you trade this; you don't just chart it. So, I mean, are you long here? And if you are, I mean, do you have a stop somewhere?
Actually, what I've done for about the last, say, 10 months is I've gone heavily into accumulation for storage.
Mm,
I'm not going to touch it. And I tended to buy a lot of the metals at a more favorable price. I started buying, I remember, at around 1,500. I bought it at 2,000, and I've still got that.
Silver's biggest signal may not be its price. It may be what disciplined buyers refuse to sell. According to Gary Wagner, he has spent roughly 10 months accumulating physical metals for storage rather than trading every short-term swing. That distinction matters because leverage forces decisions when volatility spikes, while physical ownership can withstand corrections. Retail may watch charts, while stronger hands quietly accumulate underneath. Next, Gary Wagner reveals why patient accumulation can outlast the next correction.
So I was basically dollar cost averaging on the way up. As it came down, I'm dollar cost averaging the losses, but I'm not under the guise of the leverage. I've traded futures since 1990, let's say, so quite a few years. I made a lot of money. I've also taken some sizable hits in different markets, grains being one of them when I was on vacation and left a large position open. But for me, if you're going to trade it, you want to get short-term gains, and you want to have, you're going to have that leverage in futures. Then it's much more sensitive. You would get stopped out in a modicum of areas in both gold and silver as it went down, because in a rougher way, let me blow this up. You see the series high, lower high, lower high, lower high, and you see the base that formed in it. And it held to 5,600, even maybe 5,590, which was a very strong level that used to be major resistance for silver years ago, and now had become support. We haven't seen gold react in the same way because the major resistance became around $2,000 after it traded between 1,800 and 1,900, flirted back and forth, and then it popped just above 1,900, and many people thought, okay, this is when it's going to go up to another century mark. It's 2,000, and that's when it got slammed and roughly halved. When we look at gold right now, it's about a third.
yeah.
We went from 55 to 4,000, but look at the base it was building. I'll have to recenter that. But you can see the slow and methodical move, and then you see it accelerating. The correction was almost shallow as heck. I mean, and then it went up, but there weren't parabolic moves. But you have a number of periods where it's a green candle, which simply means that the closing price is above the opening price, you draw it in green. If the closing price is below, you draw it in red.
Leverage can turn a normal correction into a permanent loss before the underlying metal even changes its long-term story. As Gary Wagner's argument suggests, futures traders face forced exits that physical holders can simply ignore. The sequence of lower highs followed by support near prior resistance matters because market structure can deteriorate faster than fundamentals. For savers, surviving volatility may matter more than predicting every swing. Next, Gary Wagner exposes why old resistance can become the market's strongest defense.
And you had an abundance of green candles on the way up. On the way down, it sold off. I said exaggerated, really because of the low that came in down here. Went up, and then it just meandered slowly. And this was a very logical point to look at because they tested, in essence, 4,400
Right.
for so many weeks. And effectively, every time the wick, meaning the differential between the real body and the low of the candle, held above 4,000, and it was for a fairly long period of time, where you don't see a series of time where it moves sideways. This is like a rounded bottom. These are all stair steps, accelerates, small correction. But it's not like when it sells off, it can be brutal. You get exaggerated new lows coming in
Right.
simply because once stops start getting hit, um, there's a liquidation and the fear of remaining long. In terms of it's hard to pick a bottom as it's coming down in a fast and furious way.
Now, listen, I mean, you said it here, Gary. That distinction matters. You're stacking physical even while the trading chart, still needs confirmation. So there's something there. I'm sure some of the stackers will be happy to hear. I wanted to kind of ask you to step back from this week for a second. I mean, 4 decades of reading these markets. What is that kind of one signal that's held up across all of it? And what would you say is maybe the one that used to work and it doesn't anymore?
Well, the one that used to work that doesn't seem to have the same punch is wars or geopolitical uncertainty. The U.S. went to war with Iran, and gold went down, silver went down, and typically when there's that kind of uncertainty or geopolitical tension, gold would react in a bullish manner.
Gold holding above $4,000 while repeatedly testing $4,400 suggests positioning is stronger than the headline-driven price action implies. What Gary Wagner is highlighting is that stair-step advances can survive shallow corrections, but stop-loss cascades can still create violent downside gaps. That creates an uncomfortable split between physical buyers and leveraged traders. If your wealth depends on liquidity during panic, the chart matters differently than it does for someone holding metal outright. Next, Gary Wagner unravels why geopolitical shocks stop producing the reaction investors expected.
We did not see that. So if we're not seeing it there, what are investors, hedge fund managers, professional traders, what are they looking at for kind of a forward guidance? And especially because Chairman Powell has exited his role, he's still there for a small amount of time. And we have a new Fed chairman for the first time in a long time. We're not certain how hawkish he's going to be. And what we're seeing is, I mean, he came out almost like a political statement. He was we're going to tackle 2% inflation. We're going to use the tools we have and make them take that level down. And in this case, his bark was louder than his bite, so to speak. In other words, he carried a big stick, but he didn't really use it. We're not seeing him be. It's easy to say it out of the not the limelight, but out of being one of the primary cogs that controls that, and that affects the economy and employment, all of those things. Once he got in the seat, those words, I remember them, but I didn't see him act on that. And so we're seeing that he's acting with maybe more patience or prudence. His target's 2%, but obviously he's not going to reach it short term. And that's where I think we got a key level of difference is geopolitical tension used to be a primary motivating factor, specifically for gold, that would move prices higher. We did not see that during this last war, recent war, in which the USA and Iran went at it. We attacked, and they started hitting all kinds of targets. And war's a nasty business. It's the one thing I enjoy seeing gold move up, but not at the cost of that. But that's just the reality of the world.
The market just delivered a warning that geopolitical fear alone may no longer be enough to drive precious metals higher. This is where Gary Wagner's thesis shifts. War once reliably pushed gold upward, yet this episode produced weakness instead. That forces investors to watch monetary policy, liquidity, and real yields more closely than dramatic headlines. The danger is assuming yesterday's safe haven playbook still works. Next, Gary Wagner exposes the policy signal that could replace geopolitical fear.
Last one here, Gary, and it kind of comes back to that here because, I mean, you flagged this yourself a month ago, August 27th, right? I mean, you called it a big one. Warsh gives his first keynote as chair on the 28th. I'm just curious, I mean, what does a hawkish surprise do to $4,500 gold? Anything here?
Well, a hawkish surprise, in other words, right now we're anticipating a rate hike of 0.25% in September, maybe one other 0.25% or 0.5% total by the end of the year. That's not really all that hawkish right now, especially when you consider where the current Fed funds rates rest. I think that he's tempered by the awareness of the position he has and how it affects people, to the point where if he continues to act the way he has, and it doesn't matter what he wants inflation to do or what he wants interest or where he wants interest rates to be. The talk's usually inflation, and interest rates are the only tool they have to control it. Again, his bite is smaller than his bark. Yeah. He's really preaching a solid game of hawkishness, and he's not delivering that. Now, that could change. But it's not as hawkish as many people anticipated it might be. And that's why you saw gold recently, I believe, partially the reason the gold moved higher and silver moved higher.
Yeah.
Because it's against the basic principle that when you have war, geopolitical tension, that tends to be extremely bullish for gold because it ratchets up the uncertainty factor. For whatever reason, that diminished on this particular run.
All right.
A supposedly hawkish Federal Reserve can still be bullish for gold if its threats never become meaningful policy. According to Gary Wagner, markets are pricing only modest additional tightening, while the rhetoric sounds considerably tougher. That gap matters because investors ultimately respond to delivered rates, not speeches. If policy stays less restrictive than advertised, real assets can retain an unexpected tailwind. Next, Gary Wagner reveals why the Fed's bark may matter less than its actual policy bite.
You know, listen, I was, as I mentioned, just this 1 week off with the family, and, you know, the gold's moving up incredibly high. I mean, it's been an interesting, volatile market, and it happens fast. But let me put a person in the middle of this, because I was getting written emails while I was off. I mean, gold obviously hit that roughly that $5,600 in late January, that record. Silver hit 121. A lot of people bought those numbers. I mean, they're still about 20% down on gold, closer to half on silver. I mean, you told me where this kind of goes if it works. Where's the line where somebody who bought that high should kind of stop hoping?
I have to differentiate between trading on futures with huge leverage and accumulating physical gold. Physical gold, typically you're in it for the long run. You don't usually flip within months or even a half-year period. You'll keep it for a couple of years. In futures, because of that liquidity, you can see, so for example, this 1 week after it started coming down, it opens at 5,000 and closes by the end of the week at 4,500. So about a 10% drop in a single week. And then it was an incremental, slower move on the way up. Typically, if a market's rallying, you don't get huge spikes. And when you get these huge spikes, a lot of time they become unsustainable. And that's what we saw here, a small retracement. We had a phenomenal move. If you look back, even as far as January 2025, you're looking a couple years back, and gold was at 2670, let's say. That's a huge move. And I think although he was talking about interest rates, Paul Volcker, the former chairman of the Fed, said, when asked, he said, well, trees don't grow to the sky. They never have. They never will. Yeah. And I thought, what a succinct way to put, there's always going to be an absolute top in a market. Even in a runaway market like this, gold won't go to the sky. Although I think it tried to touch a cloud or two there.
Buying the peak feels catastrophic, only when investors confuse a correction with a permanent thesis failure. As Gary Wagner notes, gold fell roughly 10% in 1 week, from $5,000 to $4,500, demonstrating how violently crowded markets can unwind. The larger lesson is that parabolic moves create fragile expectations, while physical holders have a different time horizon. Next, Gary Wagner exposes the historical pattern that tells investors when a correction is becoming healthy.
But the key is that these types of corrections where you've got a long, very long, as I say, I'm pegging this one leg of the rally from January 25 up to March 26.
Yeah.
So when you consider the amount of time it took and then the amount of time it took to retrace, the retracement is absolutely fair. We can always go in and do this.
That was a lot of fun there, Gary, covering that with you that year. What a run, huh?
Absolutely. Absolutely. What I've done is I have smoothed out the upper level trend line. So what I'm looking for is where it actually broke above, and on the weekly basis, that's why I'm not looking at it daily. You see that clear breakout. That's a fairly decent move from just above 4,100, and at the end of the week, right above 4,400. So that was a real good move, and then it slowed down. Right now, I've got a couple of levels of support. I had to redefine them because, of course, they were much lower. Right now, I'm seeing 4,200 as absolutely major support, but there is good support and a case to be made of 4360 with resistance coming in around 4644, and these are just based upon Fibonacci numbers.
Resistance 4644 you said, because I want to talk about that downside. I mean,
a correction is not automatically bearish when the market took months to build the advance in the first place. Gary Wagner's argument suggests the real test is whether established support survives after the breakout, not whether prices pull back from extremes. With $4,200 identified as major support and 4,644 as resistance, investors finally have levels that can challenge the narrative.